Hey there, everyone. Dave Keller here, President and Chief Strategist at Sierra Alpha Research. Great to be with you here on Stockcharts TV, hopefully helping you understand the markets a little better, give you the tools to make better investment decisions using the power of technical analysis and really leveraging the strengths of the Stockcharts platform. You know, years ago, as I was just learning the Stockcharts platform and having it become really a core part of my daily and weekly investing routines, I implemented what I call my market trend model on the Stockcharts platform and simply created a series of charts to look at the market on different time frames, short-term, medium-term, and long-term. And having interviewed a bunch of successful investors over the years, having spent a number of decades now analyzing the market trends, I found having a market trend model in the background has been super valuable because at the very least it keeps me honest and it keeps me aware of the primary market trend. I find a lot of times when investors get into trouble, it's when they are applying a toolkit that is no longer relevant for a different market phase, right? And think about how this could certainly happen in, 2022, 23, and then 24, right? 2024 has been a remarkably strong market year. The trend overall has been quite positive. We've had minimal drawdowns, right? Maybe 3 different brief pullbacks. The most severe in July and August was less than 10%. So we really haven't had a significant downdraft in quite some time. So in that sort of protracted bull market environment, this is when bad habits can really proliferate, right? They can really become way more sneaky successful than we think. Meaning we're allowed to get away with things, right? One of my favorite quotes is, "Don't confuse brains with the bull market." Right? In a bull market phase, when it feels like things are working, we can get away with little hiccups in our process because the market keeps going up, and we sort of get rewarded for that. When the market starts to turn down, and not if, but when, it will turn down at some point, all those bad habits all of a sudden tend to be magnified. And things we got away with during the previous bull cycle all of a sudden create dramatic destruction in our portfolios, or certainly have the potential to do so. So my market trend model for me is a way of just remembering and reflecting on what the current market phase is on the timeframes that are of interest to me, and making sure that I recognize when the trend is different, because what you don't want to do is apply what worked in the previous bull cycle and then keep trying to do that during a subsequent bear cycle, because you can often get absolutely crushed by trying to apply bull market strategies in a bear market phase. With that as an introduction, I want to point out the fact that as of Friday's close, my market trend model, which I've managed for a number of years, has turned bearish on the short term for large caps, mid caps, small caps, and the NASDAQ 100. So what is this market trend model? What does it mean that it turns short-term bearish? What does it mean that it's still bullish on the medium term and long term? How does that relate to previous bull and bear market cycles? And what does it tell us about the potential movements in the S&P and the NASDAQ through the remainder of this year and beyond? So here is the chart that I actually used to represent my market trend model on the Stockcharts platform, and I designed this years ago. And by the way, you can see this this chart is the first chart in my Market Misbehavior Live chart list. If you go to marketmisbehavior.com/charts, or just click on the link in the description below, you can get to this chart list with this as the very first chart. And honestly, this is the first chart that I look at every morning, and I'm not kidding, right? I fire up my laptop. I call it the morning coffee routine. I fire up the laptop. I sit down with a cup of coffee. I look at this chart, and I start here every day because I want all the other charts that I look at through the remainder of the day, which in a lot of days ends up being hundreds and hundreds of different charts. I want this to be how I am starting my day. I want this to be my initial focus, my initial point of awareness, my initial sort of grounding and the reality of the market environment. A lot of people, I think, very incorrectly do one of the following, and if this is you, raise your hand wherever you're watching this and admit it to yourself openly. If you look at financial media, which tends to dramatize and sensationalize whatever is happening right now, this moment in the trading day, as super important, right? So financial media or television, your brokerage account, right? How many of you bring up your brokerage account and just look at what's happening in your portfolio today? What happens if you're doing those things is you are automatically attuning yourself primarily, you're anchoring yourself to the short-term movements, what we call the flickering ticks of the markets. If you're a medium-term or long-term investor, if you get too drawn into the short-term, then you have the possibility, or certainly an elevated possibility, of making long-term decisions with short-term data. What you want to remember is you want to make short-term decisions with short-term data. You want to make long-term decisions with long-term data. So for me, as a medium-term, long-term investor, looking, a couple months out on average for a position, I want to be thinking about the overall structure of this market. I don't want to be thinking about what's happening at 10:10 a.m. and having that be what defines my my trading day. I want to focus on the long-term trends, and then after I've sort of defined here's where the market is, here's where it's been, and here's where I think it's headed, then I can start to evaluate what's happening this morning or this afternoon and how that relates to the overall trends that I've measured. All right. So what we are trying to do here is anchor ourselves in the most important time frame. So for me, I think of the market in 3 different time frames, and the 3 parts of the market trend model sort of reflect that. So just so you orient yourself on this chart, in the top we have a 5-year weekly chart of the S&P 500, and I have 4 exponential moving averages that are overlaid on the price. You can see the values over here. They all happen to be Fibonacci numbers, the 5-week, 13-week, 21-week, and 34-week exponential moving averages, and I'll explain why those are on the chart here in a moment. I then have what I see as the primary or the main market trend on 3 different time frames. The long-term time frame for me is the 21 and 34-week exponential moving averages. And every Friday at the close, I make a simple comparison. Is the 21-week, which is in red, above the 34-week, which is in purple? And if so, this histogram is above 0. If it's below, then it's, or if the 21-week is below the 34-week, then the histogram is below 0. And the simple analysis I make is the long-term model bullish or bearish? It is binary. I don't have a neutral setting. I kept it super simple when I was designing this because I like to simplify things, and I wanted at one glance to say, overall, is the trend bullish or bearish? That long-term trend, thinking like a year plus down the road. Then I have a medium-term trend, and I compare the 5 and 13-week exponential moving averages to make that comparison. Same thing, every Friday at the close, I compare, is the 5-week above the 13-week or below it? And that's what is shown in the histogram here. Finally, I have the short-term trend model, which for me, short-term is a couple days to a couple weeks. And so I make a comparison of the closing price as of Friday's close versus the 5-week EMA. Are we above or below that? So what's the point of using these different time frames? Well, what you have to remember is, and what I did years ago before I created this model was I basically would just look at the weekly chart of the S&P, and I would sort of think long-term first. I would say, all right, overall, thinking like a year out, like what's the general trend over the last 12 months or so? And if I would look at this chart, I would say, all right, well, there was a big downdraft here on the COVID low, then this big long-term uptrend, then this sort of downdraft into the October low of 22, this uptrend into July. Probably this whole uptrend is probably one big bull market move off of the October 22 low. Now, what I just did visually looking at the chart is basically what that moving average comparison does. The 21 and 34-week EMAs kind of comes to that same conclusion, right? It's bearish in mid-March of 2020, turns bullish in June once we've recovered off of that COVID low. Bullish all the way through here, finally turns bearish in early March of early May of 2022, and then back bullish in March of 2023, and it's remained bullish from that time. Note that it is not designed to pinpoint. It's not trying to find exact inflection points. It's a trend following model, so it doesn't confirm that the trend has changed until you have months and months of a new trend in that new direction, right? So that's the long-term model. But then what I also realized is that there are these sort of bigger, sort of smaller moves, these cyclical uptrends and downtrends, often will last, a couple months at a time, that are within the context of that long-term uptrend. So like in 2022, you had a couple kind of upswings here. We had a decent rally. So I realized that having a medium-term model, which is looking at a shorter-term set of weekly exponential moving averages, allowed me to better capture some of those swings. So for example, last year in August, September, I realized that this is sort of a decent pullback before we resume the uptrend. So the medium-term model is trying to help identify some of those more, cyclical movements within the long-term trend. Then, again, you go one layer down and you realize, okay, within those little moves, there's a lot of choppy sort of up and down swings, and that's what the short-term model is meant to represent. So at a glance, just by looking at the far right side of the chart, I can see what's the short-term, medium-term, and long-term trend. So for me, short-term, a couple days to a couple weeks, medium-term, a couple months, long-term, over a year. Generalizing, that's kind of what I would see. So as of Friday's close, and you can see a couple weeks now that we're below 0, that's just because this is a current week that is still active, right? Because we're on Monday's session today. So as of next Friday, I will update the model again. But every Friday at the close, I'll update it. So last Friday, the short-term model on the S&P 500, which is the main one that I run, turned negative. It's been bullish. It had been short-term bullish since the beginning of September. It is just starting to turn negative. You can see, looking back through the course of 2024, 3 other times when the short-term model has turned negative. In August, September, which was here, in July, August, which was there, and then in April, which was right here. So the 3 major drawdowns that we've had, and again, none of these have been significantly painful, right? The worst was that July, August pullback, which was about a 10% pullback, just a little less than that. But overall, that short-term model is designed to help me just identify systematically this is a pullback phase. The medium-term model has been bullish since November of last year. So since October 23, the medium-term model has really turned bullish in November of 23, a couple weeks after the low, but it's been bullish through that time. So what does it mean when we see the short-term below zero, but the medium term remains above zero? That tells me short-term pullback, but the primary trend is still positive. I should probably feel happy continuing to have risk on the table, right, to take risks and to have my capital in long positions. I shouldn't be too concerned because this tells me that the primary trend is still positive. These are probably buy on the dip kind of scenarios, right, where there's a short-term pullback within a long-term uptrend that is still okay. But if and when the medium-term trend model would turn negative, that would tell me to really start to think more defensively, to start to take bets off, to start to rotate to more defensive positioning, to lighten up on aggressive long positions, and just focus more on capital preservation as opposed to capital growth. So short-term models turn bearish. The medium-term and long-term models still very much in the bullish camp. So I'm happy labeling this as a tactical pullback within a long-term uptrend. Now, what does this particular configuration mean relative to previous bull cycles? Like, what has happened in some of those previous times? I have a longer-term chart I'll show you, sort of learn some lessons about market cycles and what this current move may mean. Before we do that, though, just as a reminder, if you like my process, if you like what I'm talking about, you probably are really going to enjoy my market recap show. My daily market recap show has got some great reviews, and I'd love for you to enjoy it as well. If you go to my YouTube channel called Market Misbehavior, or you can go to the link marketmisbehavior.com/chartthis, you will get to my daily market recap show. We live stream every weekday after the close at 4 p.m. Eastern, 1 p.m. Pacific. And we do it on my YouTube channel, also on X, on Facebook, on LinkedIn. So wherever you can follow me and my work, on whatever platforms you use, I hope you can tune in. Make sure you have like a notification set up so you'll know when I go live. But expect me to go live right around 4 p.m. Eastern every trading day to recap the markets, applying some of these lessons to the daily market updates. Also, if you like this sort of thinking about creating models about how to minimize the impact of emotions in your investing decisions and how to develop better routines and better processes to make better investment decisions, my free behavioral investing course may be a really good place to upgrade all of the above in your own experiences. If you go to marketmisbehavior.com/free course, you can sign up for a free 5-week email course. Each week, I will have a brief video lesson. I will share with you some thoughts and some homework. It is not a free ride. It's a free course. You have homework assigned every week, and I've talked to a number of people over the years that have gone through a version of this course, and the feedback has been very positive. They've mentioned a number of times how it's just to help them rethink about how they think about their process, and I would encourage you to experience it as well. So again, go to marketmisbehavior.com/free course. All right, so how does this particular configuration with the short-term model bearish, the medium-term and long-term models bullish, how does that compare to previous cycles? So I actually made a longer-term version of this chart going back around 15 years. And if you're a Stockcharts member, by the way, you can go to my live chart list, which I shared the link to earlier. You can actually save this chart or version of this chart to your own Stockcharts login. You can go through different time periods. You can do whatever you want with it. I wish you the very best, but here's an example of what we can do going back a little bit further. And again, just thinking about the general market tendencies since the 2009 low, right? And I think in the modern financial area, kind of in the last 10 to 15 years, you really have to anchor things to that 2009 low, right? The great financial crisis, because pre-09 to post-09, very different market environment. 2013 is where we finally broke the S&P out to new all-time highs above the 2000 and 2007 peaks. And from 2013 to 2024, with some fair, decent declines and 2018 and 2020 and 2022. Overall, the secular bull market has been fairly consistent over that period. Now, this sort of time frame, we're looking at 15 years, the short-term model is going to be really noisy, and that's kind of the idea, right? The short-term model is not designed to give you long-term signals. Remember what we talked about. You make short-term decisions with short-term data. So the daily or the short-term model for me is really something I use the daily S&P chart more than anything, right? When I'm talking about recently the line in the sand of S&P 5650, when I'm talking about bearish divergences with momentum and breadth, when I'm talking about tactical support and resistance, that's all better done, I think, on a daily chart of the S&P, at least for me it is. So the short-term model is really just a placeholder just to make sure that within the medium-term and long-term timeframes, I have a sense of the short-term trend and just the short-term direction, right? How likely is it that we get a change in one of these longer-term models, because a change in the short-term model is what usually, and if not always, comes first. So it's a little too noisy to sort of think about on this time frame, but look at the other two time frames and you can sort of see the general shape of the market trend since the 2009 low. And I'm starting at sort of late 2009, just so we have a good 15-year period. So coming out of the '09 low, the long-term model in particular, bullish, went briefly negative in Q3 and then turned bullish right before the end of 2011, sort of signaling this new uptrend phase. Went bearish here at the end of 2015, briefly positive there, but then really turned positive for a while in April of 16, all the way bullish until the 2018 pullbacks, 2020 pullback, and then the 2022 pullbacks. All right, so the point of this long-term model is just to really get those broad secular trends and recognize when we have enough of a shift that really, I mean, if I'm long stocks when this long-term model is bearish, I'm just not doing it right as a trend follower, right? If I really am a trend follower and my goal is to follow trends, then the most important thing is to get out of the way when the trend is not bullish, right? And if you look at active management, right, the way that active money managers tend to make money over the long term, over multiple cycles, is not because they're so good in bull markets. Bull markets are actually incredibly difficult as an active manager because you have to outperform an index that's already going up. It's way easier to outperform in down markets. And if you look at active managers that have been successful over time, it's not the bull markets that tend to get them the big periods of outperformance. It's bear markets where they can get defensive, go into cash, be in lower volatility areas of the market, be in defensive areas. So when the market trends go down, they're out of the way. So that long-term model, it's so important to me, and it doesn't happen often, right? Every couple years at best, you're getting a signal. But it's a great reminder that if and when that happens, you have to acknowledge that the trend is no longer bullish, and you have to make sure you're positioned for the overall market trend. However, what you will note is in like 2022, for example, even though the trend had been down for about 4 or 5 months, only in May of 2022 did my long-term model turn bearish, because it's waiting for such a trend reversal that it's not super reactive, right? If the market does change, it takes quite a while for that long-term trend to shift, and that's on purpose. That's the design of it. So the medium-term model is much more of a risk gauge for me. When the medium-term model is above zero, I tend to be risk on. When the medium-term model is below zero, I tend to be risk off. Now, what does that actually mean? Well, it's hard to really attribute or to suggest what you do with your portfolio. And that, again, I'm not attempting to give you any recommendation of any sort, as always, just for educational purposes. But for me, it's all about how I'm approaching the market environment. When the medium-term model is below zero, I focus more on capital preservation. My goal is to recognize that a lot of things are starting to go down, and so I want to minimize my my drawdowns, right? So I want to make sure that my stops are updated. I want to make sure that when any support levels get broken, that I am unwinding positions and taking profits, and just making sure that I don't ride some position down to be a climactically negative loss in my portfolio. Now, it doesn't mean that I don't own good charts. As I say at the end of every video that I do, it's always a good time to own good charts. But I think when the medium-term model is negative, it's just a reminder that there probably aren't as many good charts. So while I'm always happy to own things that are going up, and I wouldn't sell something that's going up just because I think I need to, it does tell me to just be more aware of breakdown potential and make sure that I'm focusing on locking in profits and minimizing deterioration in the portfolio. So the medium-term model was last negative toward the end of 2023, sort of in that third quarter into the early fourth quarter into that October 23 low, which for me is the last time I was really sort of, defensively positioned where I was sort of lightening up and really, and again, and it ended up not being that bad of a drawdown. It ended up being, fairly relatively painless compared to historical downtrends like in 2022 or 2020. However, it was enough for me to start lightening up and then wait for the bullish trend to reemerge, to reinitiate long positions and to add risk back into the portfolio. All right. So what does it mean for where we're at right now relative to these previous moves? Think about what's happened when the model has been bullish for longer stretches of time, like 2012, 13, 14, 15. Look at what happened toward the end of that move. The short-term model kind of turns negative often, right? Because that's really based on the short-term swings of the market. When the medium-term model turns negative, that's my sign that I really want to start to be, more cautious. And then when the long-term model would go below zero, particularly after a long period of being bullish, that's when I want to make sure I'm out of the way. You saw a similar thing here at the 2020 peak, where you had a longer period over a year of the model being bullish. We can see the short-term model obviously turn negative, the medium-term, and then the long-term. Obviously, this was the COVID, crash, and so it happened very quickly. The recovery was even very quick, and it took me a little while, certainly until about May, June, for the medium-term model to be back to bullish. But that's an acceptable risk for me, right? I'm happy sacrificing the initial move to make sure that I participate in the broad move and make sure that I stay out of the way in some doomsday scenario where the price would continue lower. Most recently, you can see the rotation from 2021 to 2022. The long-term model was bullish for a long period of time. The short-term model had started to turn negative, but a number of times in 21, the short-term model turned negative, but the medium-term model remained bullish. And that looks very similar to me with what we've experienced in 24. I think 24 to 21, well, a very different environment in terms of the interest rate environment, the Fed, and all those other things. From a technical perspective, from a trend perspective, actually very, very similar. What happened in late 21 into early 22, it was really January of 22, where the short-term model turned negative, but finally the medium-term model turned negative as well. That, for me, was a big red flag telling me that maybe this isn't one of those short-term tactical pullbacks, but the beginning of a more protracted decline. Sure enough, being out of the way for the first 3 quarters of 2022 was kind of the right call. Now, how can you track this sort of thing? Again, if you go to marketmisbehavior.com/charts, you will get to this market, what do I call it? Actually, let me bring it up, because I think it's called Market Misbehaviors, Dave's Market Misbehavior chart list. There we go. Dave Keller's Market Misbehavior live chart list. There you have it. So if you go to marketmisbehavior.com/charts, it will get you to this strange URL, which gets you to this list of charts. And by the way, bookmark that, because this is a list of charts that I keep updated on my login on the Stockcharts platform. If you go back to that URL at any point, you can actually get current versions of the charts with all my annotations and updated notes as I bring them on. And these first two are super important, the market trend model, and then the daily chart of the S&P, where we're actively watching the S&P testing its 50-day moving average, watching that 5650 level, which for me is a big time line in the sand to monitor. If you're a Stockcharts member, as I mentioned, you can save these charts to your own login and do some other cool stuff to it. Also, you might have caught at the beginning that the good folks at the Stockcharts have added my market trend model as a widget on your dashboard. So I actually have this widget which tracks it for the major equity averages here in the U.S. There's another set of what I call the macro models, which follows it for stocks, bonds, commodities, and the U.S. dollar. And again, it is not a predictive trend system. It's not telling you where you should be buying or selling by any means, but it does tell you what the trends are. And again, I found that most of the time we get into trouble as investors because we ignore the signals that the markets are providing back to us. To add that widget, by the way, what you want to do is go to the upper right, make sure you have additional data panels selected, which will give you a couple more things. And then the upper right where it says more, you want to select this one called the Keller market model. It's updated every day after the close during the week, just to let you know if there are any updates. But for me, formally, I don't update the model until Friday after the close. That's when I make any updates and inform my market misbehavior premium members, as I did on this weekend's weekly flight plan, that things are changing. That's it for now. What tools and techniques, what indicators do you use to define the trend and follow them? Drop a comment below and let me know. I'm always looking to get new ideas about where to focus my time and attention for sure. For Market Misbehavior for Sierra Alpha Research, I'm Dave Keller. Thanks for joining me here on Stockcharts TV. And remember, it's always a good time to own good charts. Have a good one.